Thanks for joining me again, and if this is your first time here, you're going to find lots of videos about home buying, home selling, mortgages, a lot of mortgage videos, saving money at home, money saving tips, those kinds of things. So if you're thinking of buying a home or you are a homeowner, you're going to probably find lots of content here that suits you. I would appreciate if you hit that subscribe button so you get notified of any new videos that I launch. So this particular video is about mortgage points, what they are, and when you should agree to pay them. And also maybe an alternative and a little trick at the end of how you can use them to your advantage. So a point that you might see advertised by lenders online, or if you still read the newspaper, if anyone actually still gets a newspaper delivered, 1 point equals 1% of the loan. So I'm going to use this example, a $300,000 loan, throughout the video. So in the example of a $300,000 loan, 1 point is equal to $3,000. So when you're getting a rate quote, or you happen to see a rate listed online and it says 1 point, you know that you're going to have to also pay $3,000 on that $300,000 loan to get that rate, okay? Or if you see half a point, that's a 0.5% of the loan amount. So in that situation, it'd be $1,500, okay? What you need to understand is when I pay that point, that 1% of the loan amount, how low of a rate am I getting? So if a lender's advertising a rate that comes with 1 point, you need to also ask the question, what's my rate with no points? And then you want to see the difference. Oftentimes the difference when you're paying a point to lower the rate is you're getting about 1/4 of a point lower in the rate, roughly. That's just an average, okay? So if that's the case, you have to now go to the calculator or the computer and do some math. So on a $300,000 loan that we talked about in the beginning, if you pay 1 point, $3,000, okay, you're going to get, in my example, an estimated 1/4 of a point reduction in your rate. That's going to lower your payment by about $43 per month. So, you know, $43 per month, it's going to take you, I don't know, like how many years? I should have done the math before recording this video, but you're going to probably look at about $500 a year that you're going to see. So about 6 years before you get that paid back. Hopefully I did the math correct. Someone fact check me and troll me in the comments below if you'd like. But anyway, you see the point. You need to live in the house for a while if the 1 point is only buying you 1/4 point of 1/4% of interest rate reduction. So always ask the lender, well, what is my rate if I don't pay the point? What is my rate if I pay 2 points? And you want to do the math to see if it makes sense. If you're not planning on staying in the house for that long, then it might not make sense at all. It's probably not worth it at all to pay the points. If you're refinancing, so this is another thing. It's different if you're refinancing also. Buying down the rate with points is going to mean less even if you're rolling the points and the closing costs into the loan, okay? So think about that. Not only are you buying the rate down in that example of $3,000 for a point, but if you roll it into the loan, you're not really saving $43 per month because you're now also paying interest on that $3,000 that you just financed to roll into the loan, right? So you're also paying interest on that $3,000 each month. So maybe your savings is only $40 a month or whatever the number is. All right, so it's all about math, and it's not about what that rate looks like on paper. Don't get too mesmerized by a certain rate. It's all about the math. Now, here's where it gets interesting and where you could use points to your advantage. So when you're purchasing a home and you are negotiating with the seller, if you plan on staying in this home a while, you could negotiate having that seller cover closing costs and or points in exchange for their asking price, for example. Maybe you're a few $1,000s apart and you want to agree to, let's say you're $10,000 apart or $8,000 apart, and you say, okay, I'll come up to your price, but I need you to pay for my points to the lender. I want to be able to buy my rate down. And so then the seller might agree to that, to give you came up 8,000, they came down 3,000, so you're at 5 now, but the seller is paying for your points on the in the contract on the sale of the house. So the seller is essentially helping you to offset those costs, because over time, that 0.25% that it might buy you down will hopefully offset the higher price you just paid in the house. So that's another example. It works really well with FHA loans too, because FHA loans will allow the seller to cover up to 6% of the purchase price to cover closing costs, including discount points. So that's a great, I know that with FHA loans, many borrowers and or sellers use covering closing costs to their advantage. It works to your advantage whether you're selling or whether you are buying, and having, throwing in the cost of points to help lower your rate and save you thousands of dollars over the life of the loan, if you happen to be there for 30 years, is something that you should look into. Hopefully this explained a little bit more about points and when you should pay them and what they're all about. If you have any questions, ask them down below in the comments. If you enjoyed the video and you find it helpful, I would appreciate you hitting that like button and share it with your friends, and also subscribe to the channel and everything else that everyone asks you to do too. So thanks again for watching, and I'll see you next time.